Welcome back to the channel. Today, we are going to do something different. We aren't just going to look at today's candle and guess what happens tomorrow. We are going to zoom out, way out. Is the party over? That is the question plaguing the mind of every single crypto investor right now. If you look at the charts, if you look at your portfolio, and if you scroll through Twitter or X, the sentiment is clear. Panic. Absolute, unadulterated fear. We are seeing Bitcoin shed value. We are seeing altcoins bleed. And the voices of the skeptics are getting louder. You hear them saying, "I told you so." You hear them calling for Bitcoin to go back to zero or to $20,000. It feels like the sky is falling. But what if I told you that this crash, this painful bleeding correction, was not only expected, but it was actually necessary? We are going to analyze a very specific, data-driven thesis that suggests that Bitcoin is currently completing its final leg lower. Yes, you heard me right. The final leg. According to a comprehensive analysis based on the Elliott wave principle, on-chain mining costs, and statistical z-scores, we are likely staring at the bottom formation right now. We are going to break down an article and an analysis that foresaw this drop 2 months ago. While everyone else was screaming moon in November, this analysis predicted a drop to the high 50,000s. And now that we are here, that same analysis is pointing to something incredible. It is pointing to the next major bull run. A run that could take us not to $100,000, but to $164,000 and beyond. But to understand the pump, you have to understand the dump. You have to understand why we are here. So grab your coffee, turn off the noise, and let's dive deep into the data. This is the most important video you will watch this month. Let's talk about the elephant in the room. Or should I say the Chicken Little in the room. You know the story of Chicken Little, right? An acorn falls on his head, and he runs around screaming, "The sky is falling! The sky is falling!" He creates mass hysteria based on a single event, without understanding the broader context of why the acorn fell. Right now, the crypto market is full of Chicken Littles. Bearish emotions are high. When prices drop, human psychology defaults to survival mode. We feel pain of loss twice as intensely as the joy of gain. This is a scientific fact. So, when Bitcoin drops 10% or 20%, your brain tells you it's going to zero. It tells you to sell. It tells you to run. But successful investing requires us to override that instinct. It requires an objective trip down memory lane. Before we start panicking, we need to look at the track record of the analysis we are covering today. This isn't hindsight bias. This is a forecast that has played out week after week. Let's rewind. Go back to late November. The market was feeling good. People were calling for a Santa Claus rally. But in a late November update, our source analysis made a bold contrarian claim. Using the Elliott wave principle, which we will explain in detail in a moment, they stated that they were long-term bullish. However, they noted a crucial warning. They said, comprehensive, multifaceted analyses of the yearly, monthly, and daily charts indicate the potential for further decline to around $74,000 plus or minus $2,000 first before moving higher. Think about that. Then, moving into early December, the posture remained the same. While the rest of the world was hoping for a breakout, the data suggested a breakdown. They compared the current market structure to 2015, a pivotal year in Bitcoin's history. They wrote, "We can't rule out a lower low near the upper end of long-term support, $69,000 to $73,000 this year before Bitcoin takes off." Why is this important? Why am I telling you what they predicted months ago? Because if the model successfully predicted the crash that everyone is currently panicking about, shouldn't we listen to what the model says comes next? If the roadmap has been accurate through the storm, it is likely accurate about the rainbow that follows. The market is emotional. The charts are mathematical. The Chicken Little dance is an emotional reaction to a mathematical reality. We are going to ignore the emotion and stick to the math. Now, throughout this video, you are going to hear me reference the Elliott wave principle, or EWP. I know. For some of you, technical analysis sounds like astrology for men. But bear with me, because this specific methodology is used by some of the largest hedge funds and traders in the world to map human psychology. To understand the prediction of a $164,000 Bitcoin, you have to understand the basics of this theory. Ralph Nelson Elliott discovered in the 1930s that stock market prices trend and reverse in recognizable patterns. These patterns repeat themselves, but not in time or amplitude, but in form. Here is the crash course. Markets move in 5 waves in the direction of the main trend. These are called impulse waves. Wave 1, up. Wave 2, down, correction. Wave 3, up, usually the biggest, strongest move. Wave 4, down, correction. Wave 5, up, the final push. After these 5 waves are done, the market corrects in 3 waves, usually labeled A, B, and C. So, where are we right now? Why is Bitcoin crashing? According to the analysis we are dissecting today, Bitcoin has been in a complex corrective phase. Specifically, we have been tracking a massive 3rd wave extension, and now we are dealing with the messy, choppy, painful 4th wave and the setup for a final 5th wave. In the previous updates mentioned in the article, the analysts noted that typically, a 3rd wave extends to the 138.2% to 161.8% Fibonacci extension level. If you look at the price action on November 21st, Bitcoin hit a low of 80,562. This was almost exactly at the 1.680x extension. This is where the magic of math comes in. The market doesn't move randomly. It respects these mathematical ratios found in nature. After that wave 3, WYGA, we entered wave 4, WIV, and wave 5, WV. Here is the rule of thumb in Elliott wave theory. Wave 4 usually targets the 76.4% to 100% extension zone. Wave 5 then targets the 176.4% to 200% extension zone. On January 14th, the high was 97,943. The target was 99,068. It missed by a hair. That was the top of wave 4. And then, the drop, the grey wave 5, WV. The analysis predicted that this downward impulse would target the 176.4% to 200.0% Fibonacci extension zone. In plain English, that corresponds to a price target between $76,235 and $70,970. But wait, Bitcoin went lower than that, right? We saw $60,000. Does that mean the model is broken? Does that mean the analysis failed? No. And this brings us to the most critical part of understanding market bottoms, extensions, and capitulation. Let's fast forward to today. The future that was predicted in November is now our present. Bitcoin moved lower exactly as expected. It sliced through the 70,000s and bottomed out recently at $60,069. Now, the article mentions a key point. Extensions of this magnitude cannot be foreseen in advance. While the initial target was the low 70Ks, Bitcoin decided to stretch its legs. It overshot the target. In the trading world, we call this an overshoot or a throw under. It's when the momentum of panic selling pushes the price slightly beyond the mathematical target. But here is the catch. Even though it went lower than the specific number, it followed the pattern perfectly. The article states, despite the lower low, it has followed the impulse pattern we outlined week after week very well. This is the weight of the evidence. We are currently wrapping up the final waves, specifically the orange 4th and 5th waves. This is getting a bit technical, so let me simplify. Imagine a Russian nesting doll, Matryoshka dolls. You have a big wave down. Inside that big wave, there are smaller waves. Inside those, even smaller waves. We are at the very end of the smallest doll. The analysis suggests we are concluding a larger, irregular expanded flat. This is a specific type of correction that tricks everyone. It comprises a 3 to 3 to 5 pattern. 3 waves down. 3 waves up. 5 waves down. The killer wave. This final 5-wave drop is what we have just experienced. And historically, this pattern usually results in a drop of right around 50%. Let's look at the history. History shows that Bitcoin's 4th waves frequently drop 40% to 55%. Sometimes they go deeper, but that is the sweet spot for a bottom. Where are we right now? The current retracement is approximately 54%. Let that sink in. Historical average drop, 40–55%. Current drop, 54%. We are not falling into an abyss. We are not going to zero. We are landing precisely in the statistical probability zone that has defined Bitcoin's market cycles for over a decade. If you sold your Bitcoin at $60,000 because you were scared, you might have just sold the exact mathematical bottom of a multi-year cycle. But technical analysis is just lines on a chart, right? What about the real world? What about the miners? What about the cost of electricity? This is where the analysis gets even more compelling, because the charts are being backed up by fundamental physics of the Bitcoin network. Critics love to say that Bitcoin has no intrinsic value. They say it's backed by nothing but air. But those critics don't understand the laws of thermodynamics. They don't understand that Bitcoin is literally stored energy. To create a Bitcoin, you have to burn energy. You have to buy hardware. You have to pay for cooling, rent, and maintenance. There is a cost of production. Just like it costs money to pull an ounce of gold out of the ground, it costs money to hash a block on the Bitcoin network. The analysis we are reviewing today points out a critical fundamental metric that suggests we are at the bottom. Reason number 1, electrical cost. According to the data, the current E-cost, electrical cost, to mine one single Bitcoin is approximately $58,740. Why does this specific number matter? Why is $58,740 the magic line in the sand? Because miners are businesses, they are not charities. If the price of Bitcoin drops below $58,000 and it costs them $58,740 to mine it, they are losing money every single time they turn on their machines. Historically, Bitcoin rarely trades below its production cost for extended periods. It's simple economics. Price drops below cost. Inefficient miners turn off their machines because they are bleeding cash. Selling pressure from miners stops because they refuse to sell at a loss. Supply dries up. Price finds a floor and bounces back up. The article states, historically, Bitcoin rarely traded below this level for extended periods. We recently bottomed at $60,069. The production cost is $58,740. Do you see the correlation? The market found support almost exactly at the break-even price for the industrial miners. The smart money knows this. The institutions know this. They know that buying Bitcoin at $60,000 is like buying a dollar bill for 99 cents. It is fundamentally undervalued relative to the energy required to produce it. So while the charts, Elliott Wave, said, we need to go down, the fundamentals, mining cost, said, you shall not pass below 58K. This creates a massive buy zone. But that's not the only heavy hitter in our corner. Let's talk about statistics. If mining cost is the physical floor, then the Z-score is the statistical floor. The article references a metric called the MVRV Z-score. Now, I don't want to give you a statistics lecture, but you need to understand this to understand how rare this buying opportunity is. The Z-score measures how stretched the price of Bitcoin is relative to its own history. It tells us if Bitcoin is overvalued, red zone, or undervalued, green zone. Think of a rubber band. The fair value is when the rubber band is relaxed. When price pumps to the moon, the rubber band stretches up. Eventually, it snaps back. When price crashes, the rubber band stretches down. The analysis highlights reason number 2, the Z-score. They write, bear market bottoms typically form between 1 and 2 standard deviations. In plain English, a standard deviation of 2 is an extreme statistical event. It means the price is ridiculously low compared to the trend. It is an anomaly, a glitch in the matrix. The article confirms, we recently experienced a 2S, sigma, downside event, which is significant. Let's look at history. 2015. Bottom. We hit the green zone. 2018 bottom. We hit the green zone. 2022 bottom. We hit the green zone. Today, we just hit the green zone again. Now, a word of caution. The article wisely notes, While these events rarely mark the exact bottom, they signal the start of the bottoming process. This is a crucial distinction. A 2 sigma event doesn't mean price bounces instantly like a tennis ball. It means the selling is exhausted. It means the rubber band is stretched to its limit. Usually, what follows this signal is sideways or slightly lower price action. This creates a floor. This is the boring phase, the phase where retail investors get bored and leave while the whales accumulate. We are establishing the final floor. The Z-score tells us that statistically, the risk-to-reward ratio is heavily skewed in favor of the bulls. The downside is limited because of the 2 sigma limit, but the upside is merely returning to the mean and then exceeding it. In the world of investing, there is a concept called confluence. If one indicator says buy, you should be skeptical. If 2 indicators say buy, you should be interested. But when 3 completely unrelated indicators, price patterns, technical, energy costs, fundamental, and standard deviations, statistical, all point to the exact same price level at the exact same time, you should be paying attention. Let's summarize the weight of evidence presented in this analysis. Elliott wave predicted a 5-wave impulse drop targeting the low 70Ks to high 60Ks. Check. Fibonacci extensions. The 176.4 ton 200% extension zone targeted 70,970, 76,335 with a standard overshoot. Check. Mining costs. The electrical floor is 58,740. We bottomed at 60,069. Check. Z-score. We hit a 2 standard deviation event, signaling a historic oversold condition. Check. The article concludes this section by saying, both factors align with our EW count, providing weight of the evidence in favor of a significant bottom forming. We are not guessing anymore. We are looking at a puzzle where almost all the pieces are in place. The narrative that Bitcoin is dead is noise. The narrative that we are going to 20K is fear. The data says we are building a massive foundation. And what happens after a foundation is built? You build a skyscraper. This brings us to the most exciting part of the video, the target. The analysis didn't just predict the crash to 60K, it predicted what happens after the crash, and the number they are calling for is staggering. So, the bottom is likely in. Or at least, we are 95% of the way through the mud. What comes next? If the Elliott wave principle correctly predicted the drop, does it predict the rise? The answer is a resounding yes. According to the EWP count, we are finishing the red wave 4, WIV. In Elliott wave theory, after wave 4 comes wave 5. Wave 5 is the final leg of the bull run. It is the euphoric phase. It is the phase where your Uber driver starts giving you crypto tips. It is the phase where fortunes are made. The article gives us a very specific number. From there, red WV can start at least at 164K. Note the words, at least. They are talking about a move that is more than double the current all-time high. They are talking about a price point that puts Bitcoin's market cap in the trillions, competing with gold. But how do they get to $164,000? Is it just a random guess? No. It is based on the same Fibonacci math that predicted the bottom. In the next and final part of this video, we are going to calculate the path to $164,000. We are going to look at the timeline. We are going to discuss the irregular expanded flat pattern mentioned in the article, because that pattern is the key to understanding why this next pump will be so violent. We will also discuss the risks, because no model is 100% perfect. We need to know where we are wrong. We need to know the invalidation levels. If you are holding Bitcoin or thinking about buying, you cannot afford to miss the final breakdown of this target. We have established that the bottom is likely in based on mining costs and statistics. But how we get to $164,000 depends on the specific pattern we just completed. The article uses a very specific technical term, an irregular expanded flat. This is the most deceptive, frustrating, and bullish pattern in the Elliott wave dictionary. Why is it deceptive? Because it is a trap. It consists of a 3-3-5 structure. Let's break down what Bitcoin just did to you over the last few months. Wave A, the drop. We saw a three-wave move down, bearish but manageable. Wave B, the fake out. Then, we saw a three-wave move up. This is the crucial part. In an expanded flat, the B wave actually goes higher than the previous top. It made everyone think the bull run was back on. It sucked in all the liquidity. It trapped the FOMO buyers at the top. Wave C, the flush. Finally, the five-wave drop. This is the crash we just survived. It drops below the bottom of wave A. It destroys the people who bought the top, and it scares the people who held the bottom. Think of this pattern like a slingshot. To shoot a stone far, you have to pull the rubber band backwards, away from your target. The expanded flat is the market pulling the slingshot back. The deeper the pull, the wave C crash, the more tension is built up. The article states that this completes the larger red wave 4. And mathematically, once a flat correction is finished, the next move is usually explosive. It doesn't just crawl up, it launches. This brings us to the red wave 5, the final leg of the journey. Now, the number you've been waiting for, $164,000. The analysts state, from there, red WV can start at least at 164K. Where does this number come from? Is it wishful thinking? No, it's Fibonacci. In Elliott wave theory, the fifth wave is related to the first wave and the third wave by specific ratios. Typically, if wave 3 was extended, which it was, remember the 1.618 extension we discussed in part 1, then wave 5 tends to be equal to wave 1, or a 61.8% relationship to the entire move from the beginning. When you plug in the bottom we just hit, around 60K, and project the standard impulse waves upward, the minimum target for a cycle top lands in that $160,000 to $180,000 region. Let's put $164,000 in perspective. That is roughly a 2.7x increase from the $60,000 bottom. In the world of traditional stocks, a 270% return takes a decade. In the world of Bitcoin post-halving cycles, a 270% move is actually conservative. If the Chicken Littles are screaming that the sky is falling at 60K, they are going to be the ones buying your bags at 150K because of FOMO. The analysis suggests this move happens after the bottom is confirmed. We are currently in the confirmation phase. The moment we break back above the key resistance levels, mid-70Ks, the validation is complete and the road to 164K is open. But as a responsible channel, we have to talk about the what if. I want to be crystal clear. No analysis, no matter how much math or history backs it, is 100% guaranteed. The market can remain irrational longer than you can remain solvent. The article provides us with a clear invalidation zone. They wrote, "We do not expect it to drop much below $60,000. Why? Because of the $58,740 mining cost floor. However, if a black swan event happens, a global war, a massive regulatory ban, or a systemic failure, and Bitcoin crashes hard below $58,000 and stays there, then this specific Elliott wave count is in trouble. If we start seeing weekly closes below $55,000 or $50,000, we have to reassess. It would mean the expanded flat is turning into something else, perhaps a prolonged bear market. But remember the weight of the evidence from part 2. To break below $58,000, you need miners to capitulate. You need a statistical event rarer than a 2Z score. The odds of that happening are significantly lower than the odds of a reversal. Investing is a game of probabilities. And right now, the probability of a bottom is exponentially higher than the probability of a further crash. So, let's wrap this up. We've covered 5,000 words worth of data today. Let's summarize the thesis in 3 simple sentences. The crash was predicted. The drop to the high 50Ks, 60Ks was foreseen months ago by Elliott wave patterns. It is not a disaster. It is a completed correction. The floor is concrete. Between the electrical cost of mining, 58K, and the Z-score statistical anomaly, Bitcoin is standing on a massive fundamental support level. The future is bright. The completion of this pattern sets the stage for the red wave 5, targeting $164,000 and beyond. The market is designed to transfer money from the impatient to the patient. It is designed to scare you out of your position right before the move happens. When you see red candles, when you see panic on Twitter, when you feel that knot in your stomach, remember the story of Chicken Little. The sky wasn't falling. An acorn just hit him on the head. This recent crash, it was just an acorn. The tree, the massive growing tree of the Bitcoin network, is still standing tall. We are looking at a bottom. We are looking at an opportunity. Do your own research, manage your risk, but do not let fear dictate your future. CTA, call to action. If you found value in this deep dive, do me a favor. Smash that like button. It helps the algorithm find other people who are panicking and calms them down. Subscribe to the channel if you want updates on this specific Elliott wave count as we move toward that 164K target. And comment below, do you think the bottom is in at 60K, or are we going lower? Let me know your targets. I'll see you on the moon. Thanks for watching.